All right, welcome to the Explainer. Today, we are diving deep into Fed Chair Jerome Powell's latest big speech. Why? Because the Fed is in the middle of this incredibly tricky balancing act, and they've just changed their entire game plan. We're going to unpack exactly what this fundamental shift means.
So let's get right into it. Powell kicks things off with this one sentence that honestly captures the whole dilemma perfectly. Think about a high wire walker, right? If they lean too far one way, inflation takes off. But if they lean too far the other way, the job market collapses. That's it. That quote is the entire tightrope in a nutshell.
So, here's how we're going to break it all down. First, we'll look at that high wire act. Then, we'll dig into the curious state of the economy right now. After that, we'll see why the Fed basically had to tear up its old rulebook, what the new playbook looks like, and finally, what all this means for you. First up, the Fed's High Wire Act. It's all about balancing the fight against inflation with the need to protect jobs. You see, the Fed has this dual mandate from Congress. It's their two main jobs: keep prices stable and make sure as many people as possible have jobs. The problem? Right now, those two goals are pulling in opposite directions. The very medicine needed to cool down inflation could really hurt the job market, and that puts the Fed in a really tough spot.
Okay, Section 2, a curious economic balance. Let's take a look at the unusual state of the U.S. economy today. And to really get why the Fed is in such a bind, you have to understand the, frankly, weird economic picture Powell laid out. He called it a curious kind of balance, and when you see the numbers, you'll see exactly what he means.
And here is that curious balance in action. It's really interesting. On one hand, you have slowing job demand. Companies just aren't hiring as much. But at the exact same time, the supply of workers is also shrinking. You've got things like a slowdown in immigration and fewer people even looking for work. So you've got both sides of the job market, demand and supply, slowing down together. It's unusual. But, and this is where it gets really confusing, even with both sides of the market slowing down, the unemployment rate is still just 4.2%. I mean, that's historically a very, very low number. So even though things feel like they're cooling off, that big headline number still looks pretty strong. It's a real puzzle. And this chart right here really shows you just how dramatic that slowdown has been. Look at this. The economy went from adding, on average, 168,000 jobs a month earlier this year to just 35,000 a month in the last 3 months. That is a massive drop-off, a real deceleration.
So while all that's happening with the job market, remember that tightrope? While the other side of it, inflation, is starting to heat up again. Powell pointed his finger directly at higher tariffs, pushing up prices for consumers, and the Fed's favorite way to measure inflation, what they call core PCE, is sitting at 2.9%, which is still quite a bit higher than their 2% target.
All right, on to Section 3, why the rules changed. We're moving from the post-2008 world to our post-pandemic reality. And it's this really unique, kind of confusing economic situation we just talked about that is the exact reason the Fed decided to overhaul its entire long-term strategy. The old playbook just wasn't designed for an economy like this.
And you can see just how much the world has changed. After the 2008 financial crisis, the big worry for years was low growth and inflation being too low. So the playbook they wrote in 2020, it was designed specifically to fight that problem. But then the pandemic happened, and it completely flipped the script. All of a sudden, they weren't fighting low inflation. They were facing the highest inflation in 40 years.
And back in 2020, the biggest boogeyman for the Fed was this concept, the ELB, or effective lower bound. Basically, it's the point where interest rates are already at zero. And if you're at zero, you can't cut them any further to boost the economy during a recession. They were terrified of getting stuck there with no tools left in their toolbox. So, to fight that fear, their old plan was something called a makeup strategy. The idea was to intentionally let inflation run a little hot, moderately above 2%, for a while after a downturn. They figured it would average things out and, more importantly, convince everyone that the Fed wouldn't let the economy get stuck in a deflationary spiral. But yeah, then the pandemic hit. And as Powell himself admitted, what the world got was, quote, nothing intentional or moderate. Instead, we got this massive, unexpected surge in inflation. And suddenly, a playbook designed to create more inflation wasn't just useless, it was actually making things more confusing for everybody. Which brings us to Section 4, the Fed's new playbook. We're going to look at the 4 key changes to their monetary policy framework. And this isn't just some minor edit, it's a pretty major rewrite of their whole approach. This table, really, is the core of the whole thing. It lays out the before and after, and you can see the shift so clearly. They're moving away from a strategy that was obsessed with just one problem, those near-zero interest rates, to one that's way more flexible. That confusing make-up strategy for inflation? Gone. Replaced with a simple, consistent 2% target. And they're now officially taking a balanced approach to both of their goals.
So let's just boil it down. What does this all mean? 1, they're no longer obsessed with the fear of being stuck at 0. 2, they've completely ditched that complicated idea of letting inflation run hot on purpose. The goal is a steady 2%. 3, they're now just as worried about the job market getting too hot as they are about it being too cold. It's a two-way street. And 4, they're promising to be much clearer about how they make tough choices when their goals conflict.
Okay, final section. What this means for you. I know a bunch of economists in Washington updated a policy document. Who cares, right? Well, why does a change to the Fed's consensus statement actually matter? For your job, your savings, your wallet.
You know, if you take away just one word from all of this, it should be flexibility. By tossing out those old, rigid rules, the Fed is basically holding up its hands and saying, we don't know what's coming next. This new playbook is all about giving themselves room to be nimble, to react to surprises, instead of being stuck following a plan that just doesn't fit the world we live in anymore.
But, and this is super important to remember, this new playbook doesn't magically solve the problem. It doesn't make the hard choices go away. It's just a new set of guidelines for walking that same high wire. As you see here, that fundamental, really difficult tension between fighting inflation and protecting jobs, it's still there. And that leaves us with the big, multi-trillion-dollar question, doesn't it? Now that they have this more flexible playbook, what's their next move going to be? Will they prioritize stamping out this stubborn inflation, or will they focus on protecting a job market that's starting to look a little fragile? Powell said they're not on a preset course, which means their next decision just got a whole lot harder to predict. And the answer is going to affect every single one of us.